Hello and welcome to another IFRS session with AARO. My name is Stella Chege, a senior IFRS consultant and trainer with AARO Academy. In today's session, we'll be looking at IFRS 9 classification of financial instruments. We are going to cover four main topics. One, we will start with the definition of a financial instrument. Here we will discuss what a financial instrument is and what it contains. We will then look at classification of financial assets. Here, we will look at what guides entities in classification of their financial assets. Then thirdly, we'll look at classification of financial liabilities. And finally, we will look at reclassification of a financial instrument. Let's start with the definition of a financial instrument. What is a financial instrument? A financial instrument is a contract that gives rise to a financial asset for one party and at the same time gives rise to a financial liability or an equity instrument to another party, that is the counterparty. So what is a financial asset? A financial asset is an ownership claim to future cash flows or from owning an equity instrument. Now, for example, if a bank issues out a loan, it has a right to the future cash flows that come from the loan. That is, the principal and the interest that will be coming from the loan. Other examples of financial assets include, say, trade receivables, deposits with banks. It could be fixed deposits, it could be current deposits. We have also investments in government securities. That could be treasury bonds, treasury bills. And we also have equity instruments, that is, investment in shares, among others. Now, what is a financial liability? A financial liability is an obligation to deliver cash to another entity. For example, if an entity takes a loan from a bank, it has an obligation to make payments in relation to that loan. Another example is if you purchase goods on credit. The trade payable is a financial liability. Let's now look at the classification of financial assets. Financial assets are classified into either of these three categories: either carried at amortized cost, carried at fair value through other comprehensive income, or carried at fair value through profit and loss. Now, what guides entities in the classification of the financial assets that they hold? To classify a financial asset, an entity needs to perform two tests. The first test is the contractual cash flow characteristic test, or in other words, what we call the SPPI test. And the second test is the business model test. Let's start with the first test, that is the SPPI test. What do we mean by SPPI? SPPI stands for solely payment of principal and interest. Now, in this test, an entity reviews the contractual cash flows that are coming from a financial asset to check if they are consistent with the basic lending arrangement. So, what is the basic lending arrangement? In a basic lending arrangement, this arrangement includes only principal and interest. So, for example, if you invest in a treasury bond or a corporate bond, what do you expect to get? You expect to get your principal and you also expect to get interest. So in this case, an investment in a treasury or a corporate bond meets the SPPI test. Another example could be a loan issued by a bank, say at a 10% fixed interest. So you look at what are the cash flows that the bank is receiving or getting from this loan. The bank is getting principal, that is the amount that they gave out, and interest, that is the 10% interest. So in this case, this loan issued by the bank meets the SPPI test. You could also have trade receivables where you sell goods on credit. So what do you expect to get? You expect that the other entity will pay you back for the goods that you offered them. So in this case, you're getting the principal. Even though the interest element is zero, the trade receivable still meets the SPPI test. Another example could be fixed deposit accounts that you may have. So you put your money in a particular bank and you expect that you'll be getting the principal amount that you have put and also interest, if any. So that still meets the SPPI test. And you could also be having investment in equity instruments. So an investment in equity instrument, does it meet the SPPI test? Now, in the case that you purchase shares, what do you expect to get at the end? You expect that you will get dividends. Are dividends consistent with the basic arrangement? No. The dividends you get are based on performance, and they are not consistent with the basic lending arrangement. So an investment in an equity instrument is an example of a financial asset that does not meet the SPPI test. Now, for further analysis of financial assets that you as an entity may have, to check if they meet the SPPI test, we invite you to visit our website and register for our training. Let's now look at the second test, which is the business model test. Now, in this test, an entity reviews the financial asset and checks how it manages the financial asset to be able to generate cash returns. Now, under IFRS 9, there are 3 business model options that an entity could have. The first one could be the entity is holding the financial asset to collect contractual cash flows. That means that the entity purpose for holding this financial asset is to collect the cash flows that come from this asset over the period of that financial asset till maturity. Now, the second business model is to hold to either collect the contractual cash flows or to sell. Now, under this option, an entity can do both. It can either hold that financial asset over the lifetime of that financial asset to be able to collect the contractual cash flows that are coming from that asset, or it could opt to sell. So they are doing both, collecting the contractual cash flows and selling. Now, what is the difference between the first business model and the second business model? In the first business model, the main intention for holding that financial asset is to collect the contractual cash flows. Now, do sales occur? They could occur. However, they are very infrequent. In the second business model, the intention of the entity is to hold this financial asset to do both. So even when the sales are occurring, they are frequent in nature. Now, what about the third business model? This is the business model that neither fits in the first one or the second one. Mostly, the entity is holding the financial asset for speculation purposes, mostly to sell that financial asset. Remember, we are still looking at the classification of financial assets. And we mentioned that for you to know how to classify a financial asset, you have to perform 2 tests, the SPPI test and the business model test. And what classification options are there? We have the amortized cost option, the fair value through other comprehensive income, and fair value through P&L. Now, for the amortized cost option, for you to classify a financial asset under this option, it must have passed the SPPI test, and the entity intention for holding that financial asset is to hold to collect contractual cash flows. That is business model 1. Now, for instance, when a bank issues out a loan with the intention of collecting the principal and interest that comes from that loan till maturity of the loan, then that loan, which is a financial asset, is carried under business model 1. And therefore, since it passes the SPPI test and is carried under business model 1, it can be classified under amortized cost. Now, for the second classification option, that is fair value through other comprehensive income, the business model is usually business model 2, where you hold to collect contractual cash flows and to sell. Now, for the third classification option, which is the fair value through profit and loss, the entity should be carrying that financial asset under business model 3, where we said most of the time is for speculation purposes, just to sell. For instance, in the case that you buy a treasury bond with the intention of just selling, you can carry that bond at fair value through profit and loss. Other instances where you use the fair value through profit and loss option is when you want to eliminate an accounting mismatch. The standard allows you to carry that financial asset at fair value through profit and loss. Let's analyze a debt instrument and see how an entity can classify this debt instrument based on its business model. Now, you might have a treasury bond. A treasury bond passes the SPPI test. Why? The cash flows that you're getting from the treasury bond is basically the principal that you put in and interest. Now, if an entity carries that bond with the intention of collecting the contractual cash flows over the lifetime of that bond, then the entity classifies that treasury bond at amortized cost. The entity could have a treasury bond that still passes the SPPI test. However, it decides that its intention is to hold this bond to collect the contractual cash flows and also to sell. In this case, the treasury bond is carried under business model 2, and therefore it is classified under fair value through other comprehensive income. The same entity could have treasury bonds that passes the SPPI test. However, they are carried under business model 3, mostly for speculation purposes, where they just buy the treasury bond with the intention of selling it. In this case, the entity will classify the treasury bond at fair value through profit and loss statement. Let's now analyze the classification of a financial asset, which is an equity instrument. So for instance, you invest in shares. Equity instruments generally fail the SPPI test. Why? The cash flows that you're getting from a share is basically dividends, which is not consistent with the basic lending arrangement of principal and interest. The dividend is basically based on the performance of the entity. Now, when doing the classification of a financial asset, which is an equity instrument, you need to ask yourself, have you bought that share to trade it or not to trade it? In the case that you have invested in that share for the purpose of trading it, then mandatorily you have to classify it at fair value through profit and loss. Now, in the case that you have invested in that share, but your intention is not to trade it, you have an option to classify it at fair value through other comprehensive income. Please note, this is an option. In the case that you do not select this option, you can still classify the equity instrument at fair value through profit and loss statement. Let's now look at the classification of financial liabilities. Generally, financial liabilities are classified at amortized cost. However, an entity can designate the financial liability to be classified at fair value through profit and loss. So in the case you want to designate it at fair value through profit and loss, you should have a reason. So for instance, that financial liability could have an embedded derivative. It could be you want to eliminate an accounting mismatch. Maybe there's a related financial asset that is carried at fair value through profit and loss. Or maybe the financial liability is evaluated on a fair value basis. So the key thing that you have to note, if you designate a financial liability to be classified at fair value through profit and loss, this decision is irrevocable. So you cannot change that classification. Let's now look at reclassification of financial instruments. Is an entity allowed to reclassify a financial asset? For example, to reclassify from the amortized cost option to the fair value through profit and loss option? Yes, reclassification is allowed, but only when the entity changes the business model. Now, is an entity allowed to reclassify a financial liability from either fair value through profit and loss to the amortized cost option? No. Reclassification of financial liabilities is not allowed. Thank you for listening to this IFRS session. To learn more about IFRS 9, which includes measurement of financial assets, that also includes impairment of financial assets, kindly visit our website and register for our training. Kindly remember to like and subscribe to our AARO Academy channel.